traded volumes displayed on a screen. Okay, it's not the order book, it's not the orders which are still coming into the market, but order flow is traded quantities displayed as the ones, okay, which came on the buy side of the market, and the ones, okay, which came on the sell side of the market. So a simple way, okay, to understand it, all the greens, okay, which you would see. So a basic understanding of order flow is that within a candle, all that appears on your right hand side, because it's green, okay, you can immediately make out that it is buyer dominated volume. And all that appears on the left hand side of the candle, this is the candle for this bar. Okay, this is the candlestick of this bar, and this entire information of this candle has been broken down into the volume which was traded by buyers and the volume which was traded by sellers. And how do we know which one is which? Simple thing, okay, the green one is the volume dominated by buyers, and the red one is dominated by sellers. Now you will have a question over here, Shai, what is the importance of trading with traded volumes? Okay, why not, okay, go into the order book and show the order book, because that is, okay, what order flow also is. And you are correct, okay, that is order flow. But what really happens when it comes, okay, to the business of trading, okay, the traded quantities have a different effect on traders, work, okay, differently after you are in a trade. So let's take an example. Okay, suppose, okay, you are a big trader, you are familiar with the way markets work, and you've gotten yourself, okay, pretty used to how markets function. Now you're confident and you are trading size in the market, and it could be anything big. Okay, let's say, okay, you're trading about 500 lots at one time. Okay, you have that splitting software and all, we'll not get into all that. But suppose, okay, you have, okay, about 500 lots of trades, okay, you put at one point in time. Okay, now you know everything about the market, you know how it goes and everything, you made a plan and you executed, okay, that quantity in the market. Now suppose, okay, you bought those 500 lots and you expected the market to go up. Okay, and when you were buying that, you had a plan that this was going to be your stop loss and this was going to be your target. Okay, but the market, okay, suddenly, okay, decides to drop down. Now you're 50 points down, okay, from your original entry position. Bad thing, okay, it's not a really a good thing, and you don't want to be a trader, okay, in that kind of a situation. Okay, but you had a plan that, okay, you would still keep a stop loss of about 100 points and you would look for a gain of 200 points. But now you're 50 points down, okay, from your point of entry in 3 minutes. Now everything in your universe changes. Okay, your plan goes for a toss and you really do not know what to do. So the next best thing you do is you exit that entire position in a loss. Now, this is the actual philosophy at work in markets. When the markets are moving and positions go what we call upside down, they go against, okay, your normal mode of play. Traders' approach to those problems, to that situation, changes. Okay, which is why when you're going into a trade, or when you're planning a trade, or something is there in the order book, that order is not executed, it's a different ball game. But once, okay, that order is executed, the pressures of the market, okay, make it such that, okay, everything changes. Then, okay, your plan, okay, does not come to you. Like as Mike Tyson, okay, used to say, okay, once, okay, you enter into a ring, one punch, okay, on your face, and all the plans, okay, you made before you entered the ring are gone. So this is what practically happens in the market. Traders go upside down. Many times they go against their plan. When everything is going to a plan, everything is fine, you can manage your position. But a lot of traders, okay, have to understand that the market does not go up because of more demand coming in, or the market does not go down because of more supply coming in. Generally, it's a lot to do with short covering, and it's a lot to do with long liquidation. Now, what is short covering? Short covering is a market which was short, but the market price, okay, decided to move up, and traders, okay, were caught again upside down, and they had to close that position. So the market, okay, rises because of short covering. And if you walk away from that chain of thought which tells you that more demand drives the market up, no, it's not right. It's not 100% right. To an extent it is right, but it's always more demand and short covering. So what we are doing over here is we are trying to see positions of players, okay, who have got the market on their side, as well as we are trying to identify traders who are upside down. Okay, and that is why we look at order flow as a whole, okay, to see where the buyers are positioned and where the sellers are positioned. So I want you to just walk away, okay, from what you already know about demand and supply. It's true. Demand and supply is the central pole of the market. It's the axis, okay, which runs everything in the market. If I have to strip the market down and explain it in two simple words to you, it are these two words: demand and supply. That is the central axis from where everything in the market flows. Yeah, yes, there are a lot of structures in between: futures, options, stocks, and a lot of other things, okay, which go on, but the central pole is always the demand and the supply, right? And when you can track that closely, as demand increasing or decreasing and supply increasing or decreasing, you get a bigger hold of what the market is. So that is what order flow is. Order flow is helping us to track all this demand and supply live in